Imagine you've got $10,000 sitting in your bank account, and you're wondering how to make that money work for you. You've heard about dividend investing, those regular payouts from companies that can provide a steady stream of passive income. But how much dividend income can you realistically generate with $10,000? And how do you get started? In this guide, we're going to walk you through everything you need to know about building a dividend income portfolio with $10,000. From understanding dividends to selecting stocks, calculating potential income, and scaling your portfolio, we'll cover it all in a way that's clear and actionable, even if you're new to investing. By the end, you'll have a solid plan to start generating dividend income and a sense of how far your $10,000 can take you. We will keep the numbers as realistic as possible, no bluffs, only the truth. Welcome to the Trade Savvy Academy. Let's start with the basics. What are dividends? Dividends are payments that companies make to their shareholders, typically on a quarterly or monthly basis, as a way of sharing profits. Think of them as a reward for owning a piece of the company. Not all companies pay dividends, but those that do, often stable, well-established firms, can provide a reliable income stream. For example, a company might pay $1 per share annually, so if you own 100 shares, you'd receive $100 a year in dividends. With $10,000 to invest, your goal is to buy shares of dividend-paying companies to generate as much income as possible. But how much income can you expect, and what factors influence that? The answer depends on your strategy, the stocks you choose, and how you manage your portfolio over time. The first key concept to understand is dividend yield. Dividend yield is a percentage that tells you how much a company pays in dividends relative to its stock price. It's calculated by dividing the annual dividend per share by the stock price. For instance, if a company pays $2 per share annually and its stock price is $50, the dividend yield is 4%. $2 divided by $50 would give you 4%. With $10,000, you could buy 200 shares of that stock. $10,000 divided by $50 would give you 200 shares. And with a 4% dividend yield, or $2 per share, you would earn $400 in annual dividends. That's a 4% return on your investment, just from dividends. The higher the yield, the more income you can generate per dollar invested, but high yields can sometimes signal risk, which we'll discuss later. For now, know that dividend yields typically range from 1% to 6% for most stable companies, with some sectors like utilities or real estate investment trusts offering higher yields. So, how much dividend income can you generate with $10,000? Let's run some numbers using realistic scenarios. Suppose you build a diversified portfolio of stocks with an average dividend yield of 3%. If you invest your entire $10,000, you'd earn $300 per year in dividends. Simply take $10,000 and multiply it by 3% or 0.03. That's $25 per month. Not life-changing, but a solid start for passive income. If you target higher-yielding stocks, say with a 5% average yield, your annual income jumps to $500, or about $41.67 per month. These figures assume you invest the full amount and the dividends remain consistent, but they give you a baseline. To get a clearer picture, let's break down how to build that portfolio and explore ways to maximize your income over time. The first step is choosing the right investments. With $10,000, you'll want to diversify to reduce risk, meaning you shouldn't put all your money into one stock. A good rule of thumb is to hold 10 to 20 different stocks across various sectors, such as financials, consumer goods, utilities, and healthcare, which are known for reliable dividends. For example, you might allocate $1,000 to each of 10 stocks. Let's say you pick a mix of blue-chip companies like Coca-Cola, yield around 3%, Verizon, yield around 5%, and Procter & Gamble, yield around 2.5%. By spreading your investment, you reduce the impact if one company cuts its dividend, a rare but possible event. You can research stocks using free tools like Yahoo Finance or Morningstar, which provide dividend yields, payout histories, and financial health metrics. When selecting stocks, focus on quality over quantity. Look for companies with a strong track record of paying and increasing dividends, often called Dividend Aristocrats. These are firms that have raised dividends for at least 25 consecutive years, like Johnson & Johnson or ExxonMobil. Check the payout ratio, which is the percentage of earnings paid out as dividends. A ratio below 60% is generally sustainable, meaning the company can afford to keep paying dividends even if profits dip. Avoid stocks with yields above 8% unless you're confident in their stability, as ultra-high yields can indicate financial trouble. For instance, a company with a 10% yield might be struggling, and its stock price could be falling, inflating the yield artificially. Now, let's build a sample portfolio to see what $10,000 can do. Imagine you invest in 5 stocks, each with $2,000, to keep things simple. Stock A is a utility company with a 4% yield, so $2,000 buys 50 shares at $40 each, generating $80 per year. To get this number, you simply multiply your 50 shares by $1.60 dividend per share. Stock B is a consumer goods company with a 3% yield, so $2,000 buys 66 shares at $30, generating $59.40. To get this, simply multiply 66 shares by 90 cents. Stock C is a telecom with a 5% yield, so $2,000 buys 40 shares at $50, generating $100, which means 40 shares multiplied by $2.50. Stock D is a healthcare firm with a 2.5% yield, so $2,000 buys 80 shares at $25, generating $50 in dividend income. Stock E is a real estate investment trust with a 6% yield, so $2,000 buys 33 shares at $60, generating $79.20. Total annual income, $368.60, or an average yield of 3.69%. Take $368.60 and divide it by $10,000. That's $30.72 per month, enough for a small bill or a nice dinner. This portfolio is just a starting point, but it shows how diversification balances risk and reward. You could tweak it to chase higher yields, but be cautious. High-yield stocks like certain REITs or energy companies can be tempting, but they're often more volatile. For example, a 7% yield sounds great, but if the stock price drops 20%, your total return could suffer. A balanced approach, targeting 3 to 5% yields from stable companies, is safer for beginners. You can also consider dividend-focused exchange-traded funds like the Vanguard Dividend Appreciation ETF known as VIG or Schwab US Dividend Equity ETF known as SCHD, which offer instant diversification and yields around 2 to 4%. ETFs are a great option if you don't want to pick individual stocks, though their yields are often lower than a carefully curated stock portfolio. Once your portfolio is set, you'll need to decide what to do with your dividends. You have 2 main options: take the cash or reinvest the dividends. Taking the cash gives you immediate income, which is great if you need the money now. For example, $368.60 per year from our sample portfolio could cover a utility bill or 2. But reinvesting dividends can significantly boost your income over time through compounding. Many brokers offer dividend reinvestment plans known as DRIP strategy, which automatically buys more shares with your dividends. Let's say your portfolio yields 3.69% annually, and you reinvest the $368.60 from year 1. Assuming the stock prices and dividends remain constant, a simplification, you'd buy about 12 additional shares at an average price of $30. In year 2, those extra shares generate more dividends, increasing your income to $382.21. Over 10 years, with reinvestment and no stock price growth, your annual income could grow to around $500, and your portfolio value could reach $13,800, assuming a 3.5% average yield. Compounding becomes even more powerful if your stocks increase their dividends over time. Many dividend aristocrats raise payouts annually, often outpacing inflation. For example, if your portfolio's dividends grow by 5% per year, your $368.60 income could climb to $599.57 after 10 years, even without reinvesting. But if you combine dividend growth with reinvestment, your income could exceed $800 annually after a decade, with a portfolio value approaching $16,000. These projections don't account for stock price appreciation, which could further boost your returns, or declines, which could reduce them. The key is to stay patient and let compounding work its magic. Taxes are another factor to consider. Dividends are typically taxable, either as ordinary income or at the lower qualified dividend rate, 0 to 20%, depending on your income. If you hold your stocks in a tax-advantaged account like an IRA, you can defer taxes, allowing your portfolio to grow faster. With $10,000, a Roth IRA could be a smart choice, as qualified withdrawals are tax-free. Check with a tax advisor to see what's best for your situation, but know that taxes can eat into your income if you're not strategic. What about risks? Dividend investing isn't foolproof. Companies can cut or eliminate dividends during tough times, as some did during the 2008 financial crisis or the 2020 pandemic. Diversification helps, but you should also monitor your stock's financial health. Economic downturns can hurt stock prices, reducing your portfolio's value, though dividends often provide a cushion. To mitigate risk, stick to high-quality companies, avoid overpaying for stocks, and keep some cash reserves to buy during market dips. With $10,000, you might start with $8,000 invested and $2,000 in cash to seize opportunities if prices fall. Can you scale your income beyond $300 to $500 per year? Absolutely, but it takes time and additional capital. If you add $500 monthly to your portfolio at a 4% yield, you'd contribute $6,000 per year, generating an extra $240 annually. After 10 years, with reinvestment and 5% dividend growth, your portfolio could produce over $3,000 per year in dividends. Alternatively, you could explore dividend-focused mutual funds or closed-end funds for higher yields, though they come with higher fees and risks. The key is consistency. Regular contributions and reinvestment can turn $10,000 into a meaningful income stream over time. In conclusion, starting with $10,000, you can realistically generate $300 to $500 per year in dividend income, or $25 to $41.67 per month, by building a diversified portfolio with 3 to 5% yields. By choosing quality stocks, reinvesting dividends, and adding to your portfolio, you can grow that income significantly over time. Dividend investing is a marathon, not a sprint, but with patience and discipline, your $10,000 can become the foundation of a robust passive income stream. Open a brokerage account, research your first stocks, and take that first step today, and your future self will thank you. If you found this video helpful, don't forget to like, subscribe, and hit that notification bell for more tips on building wealth. Let's make your retirement dreams a reality. See you in the next video.